All right, so in this video, I'm going to talk a little bit about market multiples and some other calculations that can be relevant for valuing a share of stock. So the first one I'm going to look at is book value per share. So book value per share takes the total common equity and divides it by the number of common shares outstanding. So let's back up for a moment. So if you think back to the accounting equation, we have assets equals liabilities plus owner's equity. So if I take assets minus liabilities, minus any preferred stock, if there is any preferred stock, then what I should be left with is the value of the total common equity. So really, in a way of thinking about this is theoretically that number, that total common equity figure that you get, represents the dollar figure of the assets that are on the balance sheet that were essentially financed by common equity. That's the idea. If I divide that by the number of common shares outstanding, then theoretically what that's telling us is the dollar value of assets behind every share of stock. Now, generally speaking, for a lot of firms that are out there, the market price is going to be substantially higher than the book value per share. And the reason for that is people pay for stocks based upon the present value of all expected future cash flows. In other words, people are valuing companies based upon what they expect the company to earn, not based upon just the amount of assets they have on the balance sheet. So for instance, if I walked into a convenience store and I was thinking about buying the convenience store itself is going to sell for more than just the value of the plot of land or the building. It's going to be worth relative to how much money the convenience store is making. And so if the convenience store is in a very prime location for a convenience store, first off, the land is probably worth a fair amount there. The building is probably worth a fair amount there. However, what's really going to drive the value is how much money that convenience store is bringing in through the various forms of sales and things, and ultimately they're turning into profits. So similarly with a company, when you look at a market value, the market value is going to be derived strongly from the profitability that people expect the company to have, which could be quite a bit different from the dollar value of the assets on the balance sheet that's behind every share. Having said that, though, it's kind of worth noting, like, how much is behind that share of stock, and how many dollars of assets are there that are behind that share of stock. And it might give you an idea of how what the worst case scenario might be if the profits didn't materialize. Here, at least when I bought the share of stock, they've got X many dollars of assets behind the share. Now I said sort of an idea of the worst case scenario. The reality is that's not the worst case scenario. The company could go bankrupt and you could get absolutely nothing, right, when buying a share of stocks. That's always a possibility when you're buying a share of stock. The company could go under and you could get precisely zero, right? That's always a possibility. And a lot of that has to do with what exactly are those assets that are on the balance sheet and how sure are we of those values in the event that the company was experiencing financial distress and was possibly about to go bankrupt. What exactly would be driving those? Okay. Now, another thought then to kind of take that a little bit further would be the idea of a liquidation value per share. And basically one thought behind this is, well, what if we do a thought experiment and a thought exercise? What if the company actually did go bankrupt? If the company actually did go bankrupt, they had to pay off all the lenders by liquidating and selling all the assets, like what would be left over? And so if you actually run through and you kind of figure, all right, we're going to sell everything on the balance sheet. Here's how much we think it's going to sell for. Some of the land might sell for more than it's listed on the balance sheet for. But things like accounts receivable or inventories, they may not sell for the amounts that are listed on the balance sheet because if we're going through a liquidation event, kind of like the corporate equivalent of a giant garage sale, right? And everything's marked off, pennies on the dollar kind of a thing possibly. So the idea would be if that occurred and the company actually sold everything off, liquidated, paid off its lenders to the extent possible, and then just closed up shop, what would be left over for the common shareholders? And that would be the liquidation value. Find out what's left over, divide it by the number of shares. This is the liquidation value per share. And that would give you at least an estimate of, sort of what that worst case scenario is. Now, if you think about other ways to try to value a firm, one of the things you can look at would be a multiples approach. And so you're looking at how much you're paying relative to something else. So oftentimes you'll use some kind of multiple of earnings per share, sales per share, book value per share, cash flow per share, et cetera. And basically they use that to determine value in some sense. So let's kind of talk about that a little bit by using the PE ratio to start. So the PE ratio is the ratio of the price per share divided by the earnings per share. So this is basically looking at how much you are paying to buy a share of stock per dollar of earnings. Let me give you an example. Let's suppose the company has a stock price per share of $100 and it has earnings per share of $5. So the company has earned $5 per share of earnings. The stock price is $100 today. If I take the price of 100 divided by the $5 of earnings, I'm going to get a PE ratio of 20. What that means is I'm paying $20 per dollar of profit generated by the firm. So when I buy the share of stock, I'm paying $20 per dollar of profit generated by the firm. Now, if you think about that, you might think, well, all right, so do I want that to be higher? Do I want it to be lower? What am I looking for? Well, broadly, if I'm looking at like the entire market as a whole and things like that, I mean, generally you can make a good argument for I'd prefer this number to be lower if I'm buying the stock because I'm paying less per dollar of profitability generated by the firm. This is kind of like saying, if you had an opportunity to buy a business, would you rather pay $1 million or 10 million? If you're thinking, well, if it's the same business, I'd rather pay $1 million instead of paying 10 million. Well, yeah, right. I mean, I'd rather pay less to buy the same business. So similarly, if I'm looking at the economy as a whole or the stock market as a whole bunch of companies, things like that, generally you can make a pretty good argument for, I kind of like lower PE ratios. I'm paying less per dollar of earnings. And so I kind of like that. Maybe that would be better. However, when you start looking at more narrow views of this, let's say you're looking at a particular company, and the PE ratio gets a lot more complicated. So if you're looking at the PE ratio, price is based on what people are willing to pay to buy the stock, and people are willing to pay based upon their expectations. So their estimates of value are based upon the present value of all expected future cash flows. So price is based upon what people expect the company to earn. Earnings are based upon what they have already earned, which is basically behind us. And there can be a mismatch between these. Let me give you some examples of how this could occur. What if, for instance, I have a situation in which a company is a young startup kind of a company. There's a lot of potential essentially for it. And basically it could potentially grow into something really big, but it hasn't earned a lot of money yet. So if there's a lot of potential for it and it could turn into something really big, then the price may actually be factoring in all this growth we're expecting, but the earnings may not have materialized yet. They may not have made a lot of money. And taking that a little bit further, in fact, I mean, earnings, they might not have made any money at all. And if they haven't made any money at all, if they've had losses, then I can't even calculate the PE ratio because the PE ratio is how much am I paying per dollar of profit. Well, if they don't even have profit, then I can't actually calculate a meaningful PE ratio. So you could have a disconnect there where like basically the price is based upon what we're expecting. The earnings is coming from behind us, what has already occurred. And if maybe they're growing so rapidly that we're expecting great things, but it hasn't turned into anything, really wonderful yet. So that could lead to a situation in which basically there's kind of a disconnect there. And a high PE ratio is really more related to the expected growth. On the other hand, it could be a high PE ratio because people are just overpaying. They're paying too much relative to the profitability of the firm, and it's not a good option. So that would be kind of not good, right? Another possibility would be, what if I had a situation where we had a really low PE ratio? Well, there could be a couple of ways that could happen. I can have a low PE ratio because people got really pessimistic about the future, and maybe people got unreasonably pessimistic about the future, and so the price went way down relative to the earnings. And you look at that and you think, actually, I can buy this at a bargain basement price. This is actually a really attractive deal. I'm paying very little relative to the earnings. This company's going to be fine. That could be true. It could be that people got really super pessimistic about the future. They got excessively pessimistic, and there's actually a possibility it's going to be fine. There's another possibility with a low PE ratio, though. Another possibility is the company has no future. Think typewriters when computers were coming out, right? Basically, it's like the writing is on the wall. The future is bad. And even if they had made all kinds of money previously, right, their prospects were not good. So in that case, basically you could have a low PE ratio, and it's low justifiably because basically, even though the earnings have been great, the future is bad, right? And so you can have essentially that kind of situation. So on an individual case by case basis, you really have to look at why a PE ratio is high or low. Is it due to some kind of a one-time event where they unusually had extra earnings or had a surprise loss? And that could warp the ratio. Is it due to high expectations of growth? Are we sure about those expectations of growth? How do we think that's really going to play out? Or are people being unreasonably pessimistic? What combination of factors led to the P/E ratio that we're observing? So you really have to look at it on a case by case basis and really kind of analyze that before you start making conclusions on an individual stock basis. But across a whole portfolio of stocks, generally speaking, if we're paying less per dollar of earnings, we prefer that, right? And you can apply similar logic for price to sales. Now, a little note about price to sales: different industries have very different profitability levels relative to sales. Okay. So here's what that basically translates to. Some companies, they have a lot of sales, but a huge amount of that is cost for their product. So not a lot of money makes it down to profitability. Other companies, they don't have a lot of cost of goods sold, so a lot more of it flows straight down to the profit. So I could have a situation which is big disconnect there based on industry, and so that can make a big difference. Now, similarly for like price to book, kind of talked about this a little bit with the book value per share. Just looking at how much we're paying in terms of market value relative to the book value. Generally speaking, we would assume that the price would be higher than the book value per share, and the reason for that would be that the price is related to what we expect earnings to be, and so that's based on expectations of growth and future profitability and so forth. Whereas the book value is just based on those asset values on the books right now. So probably that's going to be price is going to be higher. But the higher it gets relative to the book value, then the more it might make you want to think a little bit, and you should kind of be evaluating that carefully. All right. So really kind of what we're looking at with these multiples is how much are we paying relative to some kind of underlying metric? And that's essentially what these multiples are kind of coming from. How much are we paying relative to that some other metric that we've got here? Now, to look at a couple of brief examples here, let's assume I'm looking at the P/E ratio. And I'm going to use an assumed value of a P/E ratio of 10 or a multiple of 10. So if a firm was expected to have $12.50 of earnings per share, if the P/E ratio was 10, the idea would be I'd take that $12.50 of earnings per share times that 10 multiple. That would give me an estimate of the value of 125. Now I could then compare that and say, all right, well, what if the stock is actually selling for $100? Well, based on this, we think it's worth 125, selling for 100 currently. Looks good, right? So you could do that. Now the problem with this is, where am I getting the multiple of 10 here? And is that an appropriate number that we should put in? So let's kind of talk about that a little bit more. There is another way I could sort of construct this or present this. A multiple of 10, so multiplying by 10 is actually the same thing as dividing by 0.1 mathematically. So I could kind of show this same calculation as being like $12.50 divided by 0.1. The reason why I'm kind of presenting that as an alternate view is that's kind of like having a payment divided by a rate, kind of like a perpetuity. So this would be kind of like assuming that the firm was going to produce $12.50 every year forever, and then I'm using a discount rate of 10%. The reason why I'm presenting that would be to make you kind of think a little bit of, so if I'm using that 10 multiple, it kind of could be viewed as perhaps in certain contexts being consistent with having a earnings per share of $12.50 that lasts forever and using a discount rate of 10%. Well, if that discount rate of 10% doesn't seem like that would be high enough to justify the risk, then maybe I ought to use a different number. And so hopefully that kind of gets you thinking, well, maybe this isn't the right multiple we ought to use. Maybe we ought to use a different multiple that'd be consistent with a higher discount rate. Okay. And so if I use a higher discount rate, that would actually be equivalent to a smaller multiple, which would mean the stock is worth less. Another way to look at that would be, well, if this is my projected earnings per share divided by 0.1, because then divided by 0.1 is the same thing as multiplying by 10. That gets me to my 125. But another way of viewing that would be, what if that denominator of 0.1, what if that was the result of doing like an RS minus G, like a constant growth model? Well, if that's the case, I can have different required rates of return and growth rates that would be consistent with the 0.1. And that would actually lead to basically the scenario where I get to the 125. So in other words, if I had a required rate of return of say 15% and a growth rate of 5%, well, 0.15 minus 0.05 gives me my 0.1. So then the question would be, well, so if I'm using this multiple of 10, one possible way, not the only possible way, but one possible way to get to a multiple of 10, or to have numbers that would be kind of consistent with that, would be essentially a required rate of return of 15% and a growth rate of 5%. Well, do I think growth rate of 5 is forever is realistic? Maybe. Do I think the required rate of return of 15% is realistic? Maybe that's okay. So again, the only reason I'm kind of presenting this is when you're doing some of these multiple approaches, it can feel an awful lot like this multiple, the PE ratio or price to sales, whatever I'm comparing it to, can start to feel kind of arbitrary. But what I'm kind of trying to drive you towards here is the thought that you could view this a little bit differently, and then it kind of put some constraints on it. So in other words, if I put in a multiple of like 50, that would imply a super, super tiny discount rate, which kind of implies the stock has like no risk, right? And so that should make you kind of pause. Like if I'm using a really big multiple, it kind of means I'm using a tiny discount rate. Or I'm assuming that I got a load of growth relative to this discount rate. How sure am I about these assumptions? And so that would be something to kind of think about if you start using kind of a multiple approach. Okay, hopefully this video has been helpful. Thank you so much for watching, and have a great day.